Right now, this very morning, silver is sitting at $75.59 an ounce, and every single force in the global financial universe is conspiring to push it lower. What happens in the next 5 days could permanently alter the trajectory of your wealth. Stay with me. There is a particular kind of silence that precedes a financial catastrophe. Not the silence of calm, but the silence of suspended disbelief, the moment before markets finally reckon with a reality they have been collectively, desperately trying to ignore. That silence is hanging over the silver market this Monday morning, April 27th, 2026, with spot silver trading at $75.59 per troy ounce, and the weight of it should concern every investor who holds the metal with any degree of conviction about what it is supposed to do. Let us begin with the geography, because geography in this particular episode is destiny. The Strait of Hormuz, that narrow choke point through which roughly 1/5 of the world's crude oil has historically flowed, has now been effectively closed to normal commercial traffic for 9 consecutive weeks. The United States Navy is enforcing a blockade. Iran is retaliating with asymmetric strikes on shipping and regional energy infrastructure. And over the weekend, what appeared to be the faintest glimmer of diplomatic possibility, a proposal delivered through Pakistani intermediaries suggesting Iran was prepared to discuss reopening the strait, was extinguished with clinical finality when the American president canceled a planned diplomatic mission to Islamabad. Senior envoys who were scheduled to engage those intermediaries did not board their planes. Tehran, predictably and immediately, reiterated its position that it will not negotiate under conditions of threat or economic warfare. The off-ramp, such as it was, has been closed, and with it, any near-term hope that the energy shock would relent has collapsed entirely. The reaction in crude oil markets when Asian trading opened was not subtle. Brent crude futures surged more than 2% in the early hours, punching through $106 per barrel, levels not seen since early April. Goldman Sachs, whose commodity research desk carries considerable weight in how institutional money positions itself, did not wait for additional confirmation before revising its price forecasts, issuing updated projections now calling for Brent crude at $90 per barrel for the fourth quarter of 2026 as its central case, with explicit acknowledgement that risks are skewed substantially higher if the strait closure extends beyond Goldman's base assumption. These are not worst-case numbers. They are the bank's considered moderate expectation. Now here is where the casual observer makes a catastrophic analytical error, one that costs real money. They hear oil surging and Middle East crisis, and they instinctively reach for the conclusion that precious metals must be safe haven beneficiaries. Gold goes up, silver goes up. That is the script. That is how it is supposed to work. Except silver fell nearly 7% last week, 7%, in 5 trading sessions, while Brent crude was already elevated and the Strait of Hormuz was already closed. The metal that is supposed to function as a refuge from geopolitical chaos was, in practice, being sold with urgency. That disconnect is not a curiosity, it is the entire story, and it demands explanation. The explanation runs directly through the United States Treasury bond market, which is the gravitational center of the global financial system, the benchmark against which every asset on Earth is ultimately priced. When energy costs surge at the velocity they are currently surging, they do not stay contained within the energy sector. They flood into the consumer price index through dozens of simultaneous channels. Gasoline prices move first, within days, then airline fares, trucking costs, agricultural fertilizers, and industrial chemicals follow within weeks. Services inflation, driven by workers demanding wage increases to compensate for eroding real purchasing power, follows within months. The Federal Reserve, whose institutional credibility rests entirely on its ability to keep inflation anchored near 2% annually, watches these dynamics with alarm. And bond traders, who are not sentimental about such things, respond immediately. They sell treasury bonds, pushing yields higher to compensate buyers for the erosion of their real purchasing power. The 10-year U.S. Treasury yield is currently hovering around 4.33%, having risen for 5 consecutive sessions as stalled U.S.-Iran talks and continued Strait of Hormuz disruptions kept inflation risks elevated. The 2-year yield, which is the most sensitive barometer of near-term Federal Reserve policy expectations, reflects a market that is now pricing in virtually zero rate-cutting activity through the remainder of 2026. Markets are currently attributing only a 26% probability to a single quarter-point rate cut in December, down dramatically from earlier in the year when 2 cuts seemed nearly certain. That is the mechanism. That is the transmission channel that connects a naval blockade in the Persian Gulf to the price of silver on the COMEX in New York. Higher inflation expectations mean higher yields. Higher yields mean a rising opportunity cost for holding a metal that pays nothing, stores nothing, and just demonstrated it can lose 7% of its value in a week. And when you add to that a US dollar index firming toward the 98 to 99 range on safe haven flows into dollar-denominated assets, making silver mechanically more expensive for every buyer outside the United States, you have assembled not merely a headwind, but a structural siege. If you are finding this analysis genuinely valuable, if you can feel the weight of what is being laid out here, hit that subscribe button right now, because the week ahead is going to move faster than most investors are prepared for, and you need to be here for every update as it happens. This channel exists for moments exactly like this one. The week of April 28th through May 2nd is not merely another week in the financial calendar. It is, without meaningful exaggeration, one of the most consequentially packed policy weeks of the entire 2026 calendar year, and its events will almost certainly determine whether silver's current precarious perch near $75.59 becomes the staging ground for a temporary consolidation or the launching pad for the next serious leg downward. The Federal Open Market Committee convenes on Tuesday and Wednesday. The probability of a rate hold at this meeting is priced at essentially 100%. Nobody serious is betting on a rate move. But that is precisely why sophisticated investors should not allow themselves to be lulled by the apparent predictability of the headline decision. What matters is not what the committee does with interest rates on Wednesday. What matters is the language it uses, the projections it publishes, and the signal it sends about what comes next. And here, the risk for silver is acute and asymmetric. The committee is expected to release updated economic projections, including the dot plot, that deceptively simple chart in which each individual committee member marks where they expect the federal funds rate to be at the end of each calendar year. The March version of this dot plot, formulated before the Strait of Hormuz crisis had escalated to its current 9-week closure, before Brent crude had broken above $100, and before the inflationary mathematics of sustained triple-digit oil prices had been fully incorporated into anyone's models, showed the median expectation pointing toward 1 quarter-point rate cut by year-end. One cut. That was already a dramatically reduced expectation from where markets stood at the start of the year. Now consider what has happened since March. The energy shock has deepened. The diplomatic resolution that might have reversed it has collapsed. Goldman Sachs has revised its crude price forecasts upward. The inflation data that the committee will have reviewed before meeting carries the early fingerprints of oil-driven price pressures that have not yet fully manifested in the headline numbers, but will do so in the months ahead. There is a meaningful and underpriced risk that when the dots are updated this Wednesday, the median expectation for year-end shifts from 1 cut to 0 cuts. And if even 1 or 2 committee members begin signaling that the conversation about higher rates, not merely holding but actively tightening, is not entirely foreclosed given the energy dynamics, the silver market's reaction will be neither gradual nor gentle. Beyond the FOMC, the advanced estimate for first quarter gross domestic product is due later in the week, and it presents what experienced risk managers call a no-win scenario for silver. If the GDP figure surprises to the upside, if it shows the American economy growing robustly during the period when the Strait of Hormuz crisis was escalating, it reinforces the case for the Federal Reserve to keep rates higher for longer, which presses silver lower through the opportunity cost and dollar channels. If it surprises to the downside, if it reveals the early stages of a growth slowdown induced by energy price shock, it raises recession fears, which triggers a different but equally punishing form of selling in silver, as traders downgrade expectations for industrial and commercial demand and add a growth scare on top of an already suffocating rate and dollar environment. The metal cannot win this week's data calendar regardless of which direction surprises. Add to this that every major G7 central bank is meeting this week. The Bank of England, the European Central Bank, the Bank of Japan, the Bank of Canada, all expected to hold rates steady as they navigate the same oil-driven inflation dilemma consuming Washington's attention. When every central bank on Earth is simultaneously tilting hawkish, the opportunity cost of silver rises not just in dollars, but in every currency simultaneously. The geographic diversification argument that might otherwise lead European or Asian investors to rotate into silver as a dollar weakness hedge evaporates completely. There is no rotation trade available when every sovereign borrower on Earth is offering yield and silver is offering nothing. The options market is providing its own unambiguous verdict on where the balance of professional risk perception currently sits. Implied volatility for silver options has been rising steadily, reflecting institutional awareness that large moves are coming. But more revealing than the level of implied volatility is the skew, the relative pricing of put options against call options. That skew has shifted decisively and unmistakably in favor of puts. When puts are more expensive than calls on a relative basis, it means the derivatives market's most sophisticated participants, the institutional funds, the proprietary trading desks, the hedge funds whose survival depends on being directionally correct, are willing to pay a premium for downside protection that exceeds what they will pay for upside speculation. They are not hedging neutrally, they are expressing a directional view, and the direction they are expressing is down. The technical structure of the silver chart reinforces this professional positioning with what George Will might describe as the remorseless logic of arithmetic. A descending trend line connects the January peak near $121, the February lower high, and the April lower high at approximately $83.84. That declining trend line now sits somewhere between the current price and the next significant resistance area around $77 to $78, where multiple recent rally attempts have stalled. Every bounce toward that zone will be met by sellers who have been distributing silver since January, sophisticated participants who understand that the macro regime has changed and are using every episode of strength to reduce their exposure. Below the current price, the first meaningful support cluster sits between $74 and $72.75, where consolidation occurred during the February and March period. Below that, the technical map becomes genuinely alarming, with a relative void between $72 and the $65 to $68 range, where the market spent considerable time during late 2024. In the most extreme scenario, one in which the Strait of Hormuz remains closed for months, the Fed under incoming chair Kevin Warsh proves more hawkish than the market has priced, and the trapped long overhang from the 2025 rally takes the better part of a year to clear. Analysts are pointing to the 200-week moving average near $58 as a technically defensible, if deeply painful, downside target. There is a temptation when examining a market that has traveled from $30 to $121 in the span of roughly 3 years to treat any significant decline as merely a correction within an unbroken secular bull market, a temporary digression from a trajectory that remains, in essence, intact. That temptation is psychologically understandable. It is also, in the current macro environment, potentially very expensive. What the silver market has done since its January peak near $121 is not a correction in the conventional sense. It is a structural repricing. The drivers that powered the 2025 rally were specific and identifiable: an aggressively rate-cutting Federal Reserve, a weakening dollar, robust global growth expectations, and supply dynamics that had tightened meaningfully in the industrial silver market, driven by solar panel manufacturing and electronics demand. That constellation of factors created one of the most powerful tailwinds any asset class can experience, and that constellation has now been replaced, with considerable velocity, by its mirror image. The Federal Reserve is not cutting, the dollar is firming, the growth outlook is clouded by an energy shock of historic magnitude. The International Energy Agency has characterized the current disruption as the largest energy supply shock on record, and the monetary policy regime is transitioning towards something more restrictive, not more accommodative. The week's price action has itself been instructive in ways that are easy to miss if you are not watching carefully. Silver bounced modestly from overnight Asian session lows near $74.74 back toward the $75.59 to $76 range as London opened Monday morning. And that bounce, that modest, tentative grinding recovery from a 7% weekly decline, is itself a form of eloquent market communication. In a genuine bull market, or even in a genuine safe haven environment where geopolitical fear was the dominant driver, an asset that declines 7% in a week and then stabilizes does not grind sideways in a narrow range. It accelerates. The dip buyers who missed the prior rally treat the pullback as a gift, and the result is a V-shaped recovery that erases the weekly decline within days. Silver is not doing that. It is hovering uncomfortably near $75.59, unable to generate meaningful upside momentum even as the Strait of Hormuz sits closed for 9 weeks, even as Brent crude trades above $106, even as every geopolitical headline that should, by conventional precious metals logic, be sending investors toward the metal in search of refuge. The safe haven bid is not in control of this market. The metal is trading, with mechanical precision, as a leveraged short on the rate cut trade, falling every time the probability of near-term policy easing diminishes, and unable to recover even when geopolitical conditions deteriorate further. Understanding this dynamic matters enormously for the practical question of position management that every silver investor must now confront with clear eyes. The distance from $75.59 to the next serious downside target near $70 represents approximately 7%. The potential magnitude of the next leg lower if the FOMC meeting delivers a hawkish surprise, if the dot plot shifts from 1 cut to 0 cuts, or if crude oil breaks above $110 and forces further revision to inflation expectations. A move to $70 would represent a decline of more than 42% from the all-time high near $121. Below $70, the analytical community has identified the $65 to $68 zone as the next area of meaningful support. Below that, the 200-week moving average near $58 stands as the ultimate technical reckoning point, the level at which even the most structurally bearish scenarios would find some degree of historical valuation anchor. The investor who entered silver during the 2025 rally at $60, $70, or $80 needs to be honest with themselves about which of these levels represents a risk they have explicitly and consciously accepted versus a loss that would arrive as a surprise. Position sizing, stop-loss levels, and the overall percentage of a portfolio allocated to silver are not abstract risk management concepts at this moment. They are urgent and practical decisions that must be made before the next move, not after it has already occurred and the opportunity to act with deliberation has passed. The Federal Reserve meets this week. The GDP data drops this week. The G7 central banks make their decisions this week. And the Strait of Hormuz remains closed, with no diplomatic resolution in sight after the weekend's collapse of talks. Silver at $75.59 on this particular Monday morning in this particular macro environment is not a comfortable entry point for new long positions by any responsible risk-reward analysis. It is instead a moment of strategic clarity, the kind of moment that separates investors who manage risk seriously from those who discover too late that they had not. The long-term monetary case for silver, the argument that an inflationary world will ultimately reward hard assets, that industrial demand from clean energy technology creates structural support, that fiat currency debasement eventually finds its way into precious metal prices, has not been permanently invalidated by the events of recent months. What has changed is the timeline and the path. Bear markets in silver have historically lasted anywhere from several months to well over a year, depending on how long it takes the underlying macro drivers to reverse. And the drivers that are bearish for silver today, the oil price, the rate outlook, the dollar, the Federal Reserve's hawkish disposition under incoming leadership, are being reinforced by the events of this week rather than reversed. The investor who understands that, who adjusts their risk accordingly while maintaining their long-term conviction, will be far better positioned to benefit when the macro regime eventually shifts again than the investor who holds on through the coming months with their eyes closed, telling themselves that the next bounce is the beginning of the recovery. Now, before you leave, I genuinely want to know what you think. Are you holding silver through this period? Are you reducing exposure? Are you watching from the sidelines, waiting for a better entry? Drop your answer in the comments below, because this community of serious, informed investors is one of the most valuable resources you have access to, and your perspective matters to everyone watching this alongside you. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.